Well, how have the tables turned? The Chinese stock market has rebounded to hit fresh new month-long highs after being in the gutter for the past 6 months and receiving the topmost criticism from American investors. This comes after folks realize that COVID restrictions are surprisingly only temporary and not a long-term problem for the Chinese economy. And this also comes after they realize that Chinese equities are trading at decade-low valuations, and as a result, it's no surprise that stocks like Xpeng and NIO are up almost 35% over the past 5 trading days after investors realize that the Chinese EV growth story is still very much intact. And that story, along with the overall opportunity lying in the Chinese Hang Seng Index, is exactly what I want to address in this video. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's try to understand what the Hang Seng Index in Hong Kong has just done to shock most of Western investors. As you can see, in the month of October and November, it put in one of the most sharp reversals in stock market history with gains of north of 15 to 20% from the lows. And this obviously comes after the sentiment in the media is still very negative around Chinese markets, which has led many investors to think that this is simply a short squeeze and it's not going to last forever. Well, for those investors, I have a very blatant reality check. The stock market in the long term does not give two damns about what the media thinks about its situation. The market is always looking forward 9 to 12 months, and that is exactly what we're witnessing right now in the Hong Kong index. You see, it's been very well known that the valuations in Chinese equities have been very low since the start of 2021. But obviously, it's been very difficult for US investors to gain confidence in investing in China after all the mayhem we've seen in 2022. That obviously includes the election and the COVID-0 policy, which has scared people into thinking that the government wants the Chinese economy to crash. Well, surprise, surprise, in the past 2 months, both of those catalysts have been eradicated from the outlook for the Chinese economy. Not only did the election get decided in October with Xi Jinping back on top, but we also saw uncertainty being wiped out with the COVID-0 restrictions being eased significantly. And well, like I said countless times over the past few months, anybody with an unbiased viewpoint could understand that COVID-0 was not a permanent policy. It was simply a way to protect China's own citizens because unlike the United States, the majority of people in China are very elderly. And as a stock market investor, there was no more obvious sign than seeing all the FUD and fear around these short-term policies that caused mayhem in Chinese stocks. And even clowns like Morgan Stanley and JP Morgan are now coming out and saying they're all of a sudden bullish on Chinese stocks as reopening creates more positivity for growth in the country. Well, I hate to say it, but I think Morgan Stanley is way behind even social media in understanding this phenomena. And that's a big reason why despite some of the poor earnings and deliveries numbers that you saw from companies like Xpeng Motors, the stocks are still up north of almost 45% over the past 1 month. Simply put, the market discounted these stocks way too much, and if you're an investor and bought during those times of peak fear in September and October, then you did very well. And although it's difficult to predict if this momentum will continue into 2023, if you stick to your conviction in this kind of market, it looks like you will get paid in the long term if you pick the right companies. And right now in the short term, all we're seeing sentiment shift to the upside, to the right direction for Chinese equities from all these firms who had previously downgraded equities on China because of these very short-term catalysts. And if anything, this should be a massive learning lesson for any retail investor out there. Us retail investors are already at the disadvantage when it comes to the stock market, and so it's critically important for you to find the ways to break the rules of the traditional investment thesis and not get trapped by all these firms and hedge funds that try to manipulate you out of your own positions. At least when it comes to China, the Western media is simply not understanding the entire story around the technological developments, the fundamental structure, and the growth outlook for Chinese businesses. Because at the end of the day, their job is to promote onshore activities, not offshore. But it does seem like one analyst on JP Morgan's Asia business unit does seem to understand this phenomenon, and that's exactly what we're going to talk about next.
We were getting some comment from Moody's earlier in the week, which sees credit conditions getting worse in China in 2023. How do you balance risks in that space?
Well, I think sector selection and active management is obviously key. We do think there are areas or sectors that's going to get a lot of policy support, whether that's in renewable energy, whether it's electric vehicles or semiconductors. So I think those will be the areas where liquidity or credit availability will be more readily available. But at the same time, I think consumer spending is going to be absolutely crucial. And also, as and when we do get this growth momentum returning, I suspect the banks, the financial institutions, they could well be more ready to provide credit once again. Right now, I think despite the fact that central banks have done a lot of work in the past 6 to 9 months on easing monetary policy, some of which have not been fully passed on to the real economy. So I think from that perspective, the banking sector, the financial sector needs to play its role in order to fully transmit those monetary easing to the economy itself.
The weaker currencies on the other side, as we've seen with a strengthening dollar recently and a weakening dollar now actually giving a boost to these developing nation currencies, how does that factor into the equity space?
Well, I do think it's a bit premature to call for a bear market in a US dollar. Typically, you do get some degree of risk aversion when the US economy slows down or even turn into a recession. So I don't think the dollar strength is quite over yet. But it is true that the US dollar is incredibly overvalued. I think the end of the Fed hiking cycle, and also again as we look into 2023, when US economic data start to bottom out, I think those will be the time to start to bet against the US dollar.
Do you sense that we've reached a bottom yet in Chinese stocks, or is there some way to go yet?
Well, I think in the near term, you're still going to see quite a bit of back and forth with regards to the COVID lockdown in parts of China. But if I take a longer term view over the course of next, 6 to 12 months, I do think that there will be gradual relaxation in policy, and I do expect some returning growth momentum in the Chinese economy. So from that perspective, given the valuations of Chinese equities right now is pretty attractively priced, I do think in 2023, China could well be a market that could outperform the global equity market.
And well, there you go. That summarizes the opportunity that many American investors are missing about China extremely well. Not only is China growing at a faster pace in the United States, but its entire government is focused on creating a dominant tech space, which means some of its biggest companies will be the biggest beneficiaries of some of the stimulus and incentive programs that their economy is already introducing, not even accounting for the fact that stimulus is not going to be a part of their monetary policy package in 2023. And when you account for the fact that the Chinese debt to GDP ratio is much lower than the United States is at around 100% compared to 123%, you start to understand that the actual risk of investing in Chinese companies is technically lower than American companies. And so yes, although entrepreneurship and long-term innovation is still best suited in America, at least for the next 3 to 5 years, there is an opportunity brewing in Chinese equities as the mass media is creating excessive fear around companies that are actually not performing that bad. But obviously guys, that is just my opinion, so make sure to do your own research and let me know your thoughts down in the comment section below.